Understanding Price Action by Bob Volman. A reading summary for Tradebook Money. We live in a world of complex indicators, algorithmic systems, high-tech trading platforms. But Bob Volman makes a bold case for simplicity. The price action trader works with one thing only: bare candlestick bars on a clean chart. No oscillators, no Fibonacci levels, no complex tools. Just the bars, telling their story in real time. Volman wrote this book to prove one thing: any dedicated student can learn to trade from a clean chart, confidently and profitably. He uses the 5-minute chart of the euro-dollar pair as his teaching tool. But the principles apply to any market and any time frame. The reason is simple. Price action principles are rooted in the universal laws of supply and demand. And these laws do not change from one instrument to another. Whether you trade Forex, futures, or stocks, the same patterns appear again and again. The book rests on one central premise: the market repeats itself endlessly, and a trader who learns to recognize these repetitions has a genuine edge. Volman is honest about the difficulty, knows. Many aspiring traders will not survive the learning stages. The market is unforgiving, and tuition fees are steep. But for those willing to put in the work, the rewards are real. Volman identifies 7 core principles. They appear in every chart, on every time frame. Mastering them is the entire game. These 7 are: double pressure, support and resistance, false breaks, tease breaks, and proper breaks, false highs and lows, pullback reversals, the ceiling test, and the round number effect. In the next part, we will explore the first 4 of these in detail. Part 2, the first 4 core principles. Double pressure is the engine of all meaningful price movement. For prices to follow through, both sides of the market must push in the same direction, at least for a moment. When bulls buy aggressively and bears are forced to cover their shorts, that combined buying creates double pressure. The bears are buying not because they want to, but because they must. They are protecting themselves from further losses. This forced buying adds fuel to the rally. The result is a sustained move, exactly what every breakout trader hopes to capture. The second principle is support and resistance. This describes how former price levels shape future behavior. When prices bounce off a level repeatedly, that level becomes significant. Other traders notice it. Orders accumulate around it. And when it finally breaks, it often reverses roles. Former support becomes resistance. Former resistance becomes support. This role reversal principle is one of the most reliable patterns in all of price action. The third principle covers the quality of breakouts. There are 3 kinds. A false break has no buildup at all. Prices punch through a barrier and immediately reverse. These are traps. A tease break has some buildup, but not directly at the barrier. It may follow through, but usually only after a painful pullback first. A proper break stems from a tight cluster of bars, fighting it out right at the boundary. Only proper breaks deserve to be traded with confidence. The fourth principle is false highs and lows. These are micro-level failures. A bar breaks above its neighbor. Then the very next bar reverses and breaks below. This signals weakness in the breakout direction. At crucial spots in the chart, these single-bar failures can predict major moves. So these 4 principles work together. Double pressure provides the energy. Support and resistance provides the levels. The quality of the break sets the odds. And false highs and lows give early warnings. Part 3. The remaining principles, the moving average and buildup. The 5th principle is the pullback reversal. This captures corrections within trends. The market pulls back 40 to 60% of the prior swing. It hits a technical level, and it shows signs of turning. This often offers a high probability re-entry in the trend direction. It is among the most popular setups in trading, but it requires careful filtering to be reliable. The 6th principle is the ceiling test. It is subtle but powerful. Inside any arch-shaped formation, the bars at the top create an internal support level. Volman calls this the ceiling. When prices later return and bounce off this level, it acts first as a magnet, then as a launching pad for another move in the original direction. The seventh principle is the round number effect. Prices are drawn to round numbers like magnets, and battles fought at these levels often decide the direction of entire sessions. On the euro-dollar chart, the key levels are the 0, and 50 levels. A round number ahead of your trade is a favorable magnet. It can pull prices toward your target. But a round number between your entry and your stop is an adverse magnet. It can sink the position before it even develops. Now, the only technical tool on Volman's chart, the 25 exponential moving average. The slope tells you who is in charge. Upward slope, the bulls are dominant. Downward slope, the bears are dominant. Flat, the market is ranging. This single piece of information removes half of all trade directions before you even begin. But more important than any tool is the concept of buildup. Buildup is the visible tension that forms when bulls and bears battle at a price level. It appears as a cluster of alternating bars in a tight vertical span. Each bar is 5 minutes of real activity. So a 6-bar cluster is 30 full minutes of battle. When the barrier finally gives way, the losing side is trapped. Their stops trigger automatically, and this adds fuel to the breakout. This chain reaction is the mechanism that produces double pressure. The squeeze is buildup in its purest form. Bars get trapped between a pattern line and the moving average. The tension reaches its peak, and when it finally breaks, the response can be explosive. Part 4. The 4 trade setups. Volman builds his entire approach around 4 specific setups. The first is the pattern break. It is the most straightforward. Identify a barrier. Watch for buildup directly at that barrier. Find a signal bar at the end of the buildup. Then enter when the next bar breaks the signal bar by 1 pip. The signal bar must close in the direction of the break. Bullish breaks need bullish signal bars. Bearish breaks need bearish signal bars. The stop goes on the other side of the cluster. Standard target 20 pip. Standard stop 10 pip. A 1-to-2 risk-reward ratio. The second is the pattern break pullback. It offers a second chance when the first break is missed. After a breakout, prices often pull back to test the broken barrier. If the pullback finds support there, ideally at the moving average, a signal bar can trigger an excellent entry. The pullback confirms the breakout was genuine. The third is the pattern break combi. It uses a 2-bar pattern. A power bar shows strong directional commitment. Right next to it, an inside bar builds up tension. The inside bar becomes the signal bar, and its break triggers the entry. The combi is incredibly versatile. It appears in squeezes, at the end of flags, and in pullback turns. The fourth is the pullback reversal. Wait for the pullback to reach the moving average. Wait for it to retrace 40 to 60% of the prior swing. Look for a technical test at the turning point. And above all, observe the harmony principle. The bars in the pullback should not be more aggressive than the bars in the dominant swing. A gentle, reluctant pullback is reversible. An aggressive pullback usually is not. When 3 elements converge at the turning point, we call it a triple: the moving average, a round number, and a technical test. Triples are among the strongest reversal candidates in the entire framework. For the entry, picture the turn as a tiny M pattern or W pattern. The second break in the turn often produces a stronger response than the first, because it confirms what the first break suggested. Part 5. Critical filters and rules. Before taking any trade, Volman applies several essential filters. These filters separate professionals from amateurs. First, always trade in line with dominant pressure. Never fight a clear trend with a tight stop. The moving average tells you which side is in charge. Fighting it is a recipe for consistent losses. Second, never enter without buildup at the barrier. This single filter eliminates most losing trades. If there is no visible battle, there are no trapped traders to fuel the breakout. No buildup, no trade. It is that simple. Third, avoid entries far from the moving average. The average acts as a perpetual magnet. It constantly pulls prices back toward it. Entries taken far away face the constant risk of a correction that triggers the stop. Fourth, scan for obstacles on the way to the target. Former highs and lows, blocky clusters, round numbers. All of these can block follow-through. And scan for adverse magnets behind the stop. A round number between entry and stop is a serious threat. Fifth, avoid trading in frantic environments. When most bars exceed their average span, the market is volatile. These conditions favor contrarians, not breakout traders. Tight stops get hunted easily. And remember the timing. The first decent trade of the European session is usually found around the UK Open, 9 o'clock Central European Time. This is the most reliable single hour for breakout trading. Volman is just as firm about the art of skipping bad trades. Saving 1 or 2 unnecessary losses per week can decide your entire year. The 7 common errors to avoid are these: trading against a strong trend, trading into resistance, mistaking a range for a trend, entering far from the moving average, trading in frantic conditions, reversing aggressive pullbacks, and front-running breaks without buildup. The discipline to skip bad trades is not a weakness. It is a strength. Every unnecessary loss avoided is as valuable as a winning trade. Patience, selectivity, quality over quantity. These are the hallmarks of the successful price action trader. Part 6. Manual exits and trading for failure. The bracket order handles trade management automatically. A preset target and a preset stop. But Volman adds 3 manual exit techniques for advanced traders. The first is the news report exit. It closes positions ahead of major economic releases. Spikes during non-farm payrolls or interest rate decisions can exceed 50 pip, and they produce devastating slippage. Even with the right bias, slippage can turn a 10 pip loss into a 30 pip disaster. The rule is simple: step aside rather than gamble. The second is the resistance exit. It takes profits at a predetermined level of obstruction. If a former high or round number sits before your target, exiting there can be smarter than risking a reversal. But there is one key rule: determine this level before taking the trade. Never as a fear-based reaction during the trade. The minimum profit threshold should be around 14 pip. The third is the reversal exit. It responds to a genuine adverse formation. When an M pattern or W pattern builds against your position and then breaks, the trade may no longer be valid. But this requires extreme discipline. Most urges to exit are fear-based, not technical. A simple pullback to the moving average is completely normal. It should not trigger an exit. Now, one of the most powerful concepts in the book, the trade for failure setup. This turns trading errors into opportunities. You see other traders break a barrier against dominant pressure with poor buildup. So you wait for that break to fail, and you trade the counter move. These setups produce powerful, immediate follow-through because the trapped traders are forced to exit. Their forced exits fuel the move in your direction. Textbook double pressure on the failure side. There is one key requirement: the signal bar position. The turnaround bar's high must sit at or slightly above the broken barrier. This confirms the failure is genuine. And remember, trading for failure works best on the first reversal attempt in a fresh swing. Later in a trend, reversal patterns become harder to trade against. Part 7. Compounding low volatility and final thoughts. Volman dedicates a whole chapter to compounding. He calls it one of the most overlooked aspects of trading. The principle is simple. Adjust your position size in proportion to your account balance. As the account grows, position size grows. As the account shrinks, position size shrinks. But the percentage risked per trade stays constant, ideally between 1 and 2%. Consider two traders. Both score identical results. 2.5 points per week for 48 weeks. Both start with $5,000. The trader who keeps the same position size ends the year at $17,000. The trader who compounds weekly ends at $52,000. Same trades, same results. The difference is entirely accounting. The numbers get even more dramatic at higher levels. At 5 points per week, the static trader ends at $29,000, but the compounding trader reaches almost $500,000. This is the exponential power of compounding. Compounding also protects against ruin. Position size shrinks automatically during losing streaks, so it becomes nearly impossible to blow up the account if you follow the rules strictly. For low volatility, the principles stay the same, but the execution must adapt. Tighten the bracket. Be more selective. Or better yet, add more markets to your screens. In compressed markets, the battles shift from the 50 pip levels to the 20 pip levels, but the dynamics remain the same. Now, the final thoughts. The market's behavior is highly repetitive and therefore exploitable, given practice and time. This is the central truth of Bob Volman's entire work. Strategy and tactics may vary from trader to trader, but all successful traders abide by the same small set of principles. Knowledge alone is not enough. The student must study price action across hundreds, even thousands of charts before real intuition develops. The markets are not designed for comfort. The losses of one trader pay for the profits of another. To win, you must prepare more thoroughly than your opponents. Volman closes with a message worth remembering. The markets will always be there. They operated long before us and will continue long after. There is no rush. What matters is not how quickly you start, but how well prepared you are when you do. Study hard. Protect your capital. Be patient. Give yourself that fighting chance. Thank you for listening. If you found this summary valuable, please subscribe to Tradebook Money for more in-depth trading book summaries.